My name is Andrew Stotts from the Valuation Masterclass, and I want to welcome you to the Valuation Masterclass debate. The company is FASTENAL in the US, and the buyer is going to be Hassan, and Morgan is going to be the seller. This is an exciting debate, and I really think it's a critical time to think about FASTENAL because the company is incredible, but is it expensive and we should get out? Or is it time to get in? That's the question. Now, before we get started, I just want to introduce these guys. There's Hassan and there's Morgan. And I'm going to basically introduce you guys a little bit more. And I'm going to run through a PowerPoint so that people who don't know FASTENAL can understand more. But how are you guys feeling?
Feeling good.
Exciting.
Yeah. This is, for those people that have never seen these debates, these are two students in the Valuation Masterclass Bootcamp. Neither of them knew anything about FASTENAL 6-7 weeks ago. And here we are in the 7th week of the bootcamp. They've already produced a full report on FASTENAL and made their presentations. And now we thought, what a great opportunity to get the two of them who have a different view on it and let them debate it. So you guys hang on for a second. I'm going to bring you back in a moment, but I'm going to go through some things here for the audience. So let me do that. So in case you didn't know FASTENAL, let me walk you through a few things that we can go through before we start the debate, just so you've got some idea. So if we look at FASTENAL, what we can see, that's the name of the company, FASTENAL, as in fasteners. And it's an American company headquartered in Minnesota, one of the largest industrial and construction supply distributors in the world. And it provides fasteners, tools, safety products, and industrial supplies. It's got 3,560 sites, 1,499 are public branches, and 2,031 are on-site locations where FASTENAL employees are embedded into their customers. And then, of course, they've got distribution centers across the U.S. Now, really, this is a U.S. company. They have almost all of their footprint is in the U.S. And they do have, offices around the world, but they're not yet expanding around the world. The biggest mode of this company is its embedded distribution model, meaning on-site locations, vending machines that are supplying these parts, and supply chain partnership that's lock in long-term customers. And 31% of the total revenue comes from fasteners, which you can see on the left, and then safety supplies and other items. Let's look at the stock for a moment. The stock has, you can see the picture right here that right now, the stock is above both its 50-day moving average and its 200-day moving average. And of course, the company did hit some pretty high levels at $50 back in August or so of 2025. It's good to look at consensus to understand where is the market at this point. And consensus shows that people are pretty solidly a hold. But it's interesting because very rarely when you look at consensus do you see sells or strong sells, but here you see it. There's 3 analysts out of 19 that have a sell on the company and 2 that have a strong sell. The upside to the target price right now is pretty neutral, downside actually of 3%. And basically we can see that expectation on revenue growth is that it's going to slow in 2007 and slow in 2028. Now, that doesn't mean that it's going negative. It's still pretty strong at, 8.6 and 7.5. The net margin of this company is incredible at about 16%, and that doesn't seem to be affected by the analysts. If we look at our world-class benchmarking scorecard, where we compare the company against 1,410 large industrial companies worldwide, the company is financially world-class, and it has been for the past 5 years. There's a real competitive advantage, and that competitive advantage is seen through the level of profitability. In this case, profitability is return on assets. Let me introduce Hassan. He's a finance professional with expertise in equity and ETF trading, private fund management, and financial analysis. And, oh, that's wrong. That's actually not, I don't think that's you, Hassan, now that I look at it. Let's see, Morgan. So Hassan, I think we're going to have you introduce yourself. But Wargon is a financial engineering graduate with hands-on experience, and also, he's president of the KMITL Startup Hub, where he's doing his bachelor's and master's in financial engineering. Now we can look in more detail at FASTENAL. In fact, um, I don't think I can move. Let me see if I can minimize or maximize. I can't really do anything here, but the global stock tracker basically that we use shows Fastenal at a net profit margin of 15%, an ROA of 26, PE of 42 times, price to book of 14, EPS growth is 13%. That's pretty impressive. And the company's really got no debt. Well, this is the debate. We're going to have opening arguments each 3 minutes. Then we'll have rebuttal rounds each 3 minutes. Then we'll have a Q&A session where you and myself can ask questions, and then they'll have closing statements. So let's get this debate going. I'm going to get these guys in here. 1 second. Let's get in. All right. Hassan, I think we got yours messed up a little bit there on your bio.
No problem, no problem.
See, even we make mistakes, huh? Extreme attention to detail. You got to tell your teacher, right? Good. Well, I think we are ready, and that means that the games are going to begin. And Hassan, we're going to start with you because you got to buy, and then I've asked Warwick. He's already done it, and he's muted his mic. So take it away, Hassan.
Okay, everyone, am I audible?
Yep.
Yeah. Okay, so hello, everyone. And based on my equity research report on FASTENAL, I recommended a buy actually, along with a target price of $52 per share with a 12% upside derived from a DCF-based intrinsic valuation. So my case is that FASTENAL is not a cheap stock on headline multiples. However, it deserves a premium. And even after that premium, I still believe that FASTENAL is underestimated, especially based on its embedded customer model. Now, let me start off with why I believe it's a buy recommendation. The most important thing is that FASTENAL right now is going from a traditional distributor to an embedded supply chain partner. It has a massive digital footprint consisting of multiple tools, which make up around 60+% of its 2025 sales. Its multi-channel customers make up 95% of its revenue. And there has been a deliberate shift towards more embedded customers because FASTENAL has 2,000 plus on sites, and these sites have grown 14% year over year. While these sites have increased, the total customer count has fallen 8%. This clearly shows FASTENAL is moving towards a more deeply embedded customers. In the fourth quarter of 2025, we saw revenue increase, EBIT margins increase. However, gross margin fell, and I believe this was due to strong operating leverage and being able to leverage the sales, general and administrative expenses. Which brings me to my second point. Based on this fourth quarter 2025 trend, I forecasted that FASTENAL's revenue would increase 9.5% in 2026, up to 12% by 2030. It would be able to leverage its SG&A, and while gross margins would fall a little bit, EBIT margins would improve. In all, I believe that because of these reasons, FASTENAL will be able to create a more embedded and stronger operating leverage, as well as stronger fundamentals for in the upcoming years, which is why I recommend a buy recommendation for FASTENAL. Thank you.
Excellent. All right. So I've taken some notes on that, but I'm going to leave that for right now. And we're going to come back for the Q&A. I just want to take a moment to welcome everybody in here, and all the people viewing. Make sure you submit a question. I'm happy to have these guys answer it. Warwick, you are on the opposite side, saying that this company is a sell. So why don't you tell us your story? Go.
Yes. Good evening from Thailand, ladies and gentlemen. My name is Tang, and tonight I'm a representative on behalf of sales side. First of all, I'm not arguing that this company is a great company with a good foundation. The problem is its price. As why I would say I would sell this company is first, the growth is slowing to the single digit. As fast now is growing by signing new customer and selling deeper into the one it has. That engine still runs, and the daily sales still rose 12.4% in the first quarter, and daily 10 double-digit growth for like many months. But its signing grew only 8% last quarter. Once the base is this large, single-digit signing could not retain this double-digit growth. So I forecast that the revenue growth will slow down from 12% in this year to 8% by 2030. Next thing is operating leverage is thin and nearly tapped. As FastNow win more growth inside big national accounts, they achieve to serve once the hardware is installed and the cost discipline is real, with SG&A go down. But the gross margin is sliding too on the heavier contract mix. So even with sale go up, the operating margin just barely loads. So I expect that it will stabilize near the level of 20%. Even though it still sounds good, it still perform better than in the industry. But the last and most important thing is the market is paying for perfection that won't show up. As fast now trade on a very high PE, that price only makes sense if three things are on hold. Double-digit revenue growth continue, the operating margins keep climbing from 20%, and the high ROIC stay far above the industry average. Crediting a great business, I still see it as paying today for growth and margin the next 3 years are unlikely to deliver and are relating toward what the cash flows justify my 33 US dollar target price with a WACC of 8.5% and a terminal growth rate of 3% with free cash flow to firm valuation method. Thank you.
Excellent. Both of you guys have kept in your time limits. That's good. So that wraps up the opening arguments. Next, we're going to move into the rebuttal round where each side has 3 minutes to counter the opponent's arguments. They've made great arguments. Now it's time for the other side to say, wait a minute, that's not as correct as you think. Also, just to remind the viewers, submit your questions. Christiana is on fire. She's already submitted 3. So get ready for your questions, guys. And Hassan, are you ready to go with your rebuttal?
Yes.
Take it away.
Okay, so the sell side made some interesting arguments, but let me clarify that. This mentioned about the revenue forecast, and my revenue forecast is 9.5%, and it is not that optimistic because it's actually below the consensus. Consensus expects that 11.6% revenue growth in 2026, while I forecast only 9.5%. My view is that year one will not be dramatically better. However, FASTENAL will be able to increase its revenue margin year over year. This embedded supply chain, embedded customer model will and SG&A leverage will allow it to increase its revenue margin and EBIT margins over time, as we have seen in the previous quarter. These assumptions are based on past trends rather than simple, unjustified assumptions. Secondly, the sell side also mentioned about the relative valuation and the fact that FASTENAL trades at a premium. Yes, it does trade at a premium. However, that premium is justified because of excellent fundamentals. FASTENAL has amazing profitability and asset efficiency. While I still believe that even though sell side may claim that FASTENAL is expensive, it is the market is underestimating its future potential and the fact that it is it will be able to convert future earnings growth into scalable growth and grow at a steady pace over time. One more thing is that FASTENAL has a very low beta. That means it has a very strong risk profile. I forecast that FASTENAL will take up more long-term debt to finance its fixed assets, which in turn would also result in a higher valuation, supporting my buy recommendation. Thank you.
All right. So one of the things we heard there was that, well, revenue is about the same maybe for the both of you, but it sounds like the margin story is part of it. And Dang, why don't you go?
Okay, thank you for your insight, Hassan. At least we are on the same page on the revenue. But I'm still not convinced on your margin story. First of all, in order for the company to increase their revenue share and its revenue growth, they need to increase more and more on the contract, which if they operate on the contract side, its gross margin will slip more. And it slip even though the SG&A decrease still make the slip in the gross margin effect not that much, but it still does not improve the EBIT of the company to reach the level that the premium justified. And the next thing is the mode of company, which is the device network. Its mode is erode as that its rival is catch up more and more. As the Amazon Business Grinder and other distributors are investing in their own vending, e-commerce, and supply chain technology, and large consumer increasingly multi-sort. If competitor close the technology gap or undercut on price, retention and pricing our power of Fastenal will be weakened. And another point that I want to mention is that yes, company has amazing fundamental, and it might justify its premium a bit, but the price that is currently trade is price is already priced in and priced in a bit too much. And that's all for my rebuttal.
Okay, great. So before we go on, now we're going to move into the Q&A session. We got 6 minutes of Q&A. I'm going to ask some questions as well as Christiana and others who have submitted questions. Christiana is on fire, as I said. So let's go into the Q&A round now. And I want to just start here with a couple quick ones. So just to summarize, Dang, what you're saying is revenue is going to grow, but
Yes.
it's past the peak of its gross margin. Is that what you're saying? And therefore net profit is going to grow slower than revenue growth?
Yes.
Okay. And the other question about that is, you know, some people would argue that this company is already penetrated the market, but others would say, come on, the US economy is huge. There's tons of opportunity for them to expand. So on the one hand, I can see maybe they expanded to the biggest ones, the easy money first. But what is your perspective about the potential for the company to grow its number of customers? Is that massive, moderate, or small over the next, I don't know, 5 years?
For its growth potential, I would like to divide it into two parts. First is on its mainland, on the North American. I believe that it's moderate since it's a highly fragmented market. But in order for Fastenal to increase their share, they need to cut more of their price, which will hurt its premium of its high profitability and asset efficiency.
And
And
the reason for cutting the price is because of competition or because of what?
because of competition and in order to gain more customer.
Okay, and you had one more thing you were going to answer?
And for the on the overseas part, I think the growth potential is still debate, as Fastenal business model is they import from China, which into the US, which they can gain a significant margin from the import of part. If they going abroad, is more on as they are, its mode will erode as
Okay.
they will lose its bargaining power.
Okay. And Hassan, on your side, you know, 8% revenue growth is good. If they could widen their margins just a little bit, you've already got, let's say, 10% growth over the next couple of years. What makes you so confident? I mean, come on, their margin's already huge.
So what makes me confident is the fact that throughout in the past, Fastenal has made sure that its debt profile, its liquidity, and its debt has remained stable. It has been able to efficiently use its assets and use that to maintain a strong revenue growth. I actually did some, I actually assumed that, and justifiably, that their assets would increase. They would use long term debt more so, increase their assets, increase their capex, and thereby increase their revenue. I assumed they would invest heavily in customer on sites And as they are entering into more multi-channel customers, these customer sites, the customer count will remain stable at 8%. As I mentioned before, it fell 8%. I believe it will remain stable at that level, and customer on-sites will increase, causing revenue and margins to improve as well.
Okay, let's bring in some questions. You guys got to keep your answers short because we're going to run out of time fast. Christiana says, are we being too optimistic that Fastenal can offset gross margin pressure through scale, SG&A leverage, and customer growth? I guess, Hassan, you may want to answer that.
Yes, so I do not think we are being too optimistic at all. If you look at the fourth quarter of 2025, we see this exact trend that I forecasted for 2026. That Fastenal had high revenue growth. It had modest gross margins, and it had extremely high EBIT margins with a very good SG&A leverage. So my assumption for 2026 and upcoming years are actually based on past quarter performances. So no, I don't think we're not being too optimistic.
And let's just look at also, Christiana was saying, is the sell case underestimating Fastenal's ability to compound earnings through FMI, vending solutions, and large account growth? You know, because if you get that wrong, you know, it could have some strong growth.
I don't think I underestimate its potential, as it's already priced in my story, and as I expect that it will outgrow its industry, which is premium, but it still not justify its current price.
Okay, here comes one from Momin. Hassan, at 40 times PE, aren't we paying software multiples for an industrial parts supplier? How do you justify that if growth slows?
So for that, I will say is yes, understandable that that Fastener trades at a premium, but its premium is supported by a very superior profitability. Fastener's forecasted return on equity is very well above the benchmarks, and its 2026 PEG ratio itself is lower than the peer benchmarks, showing that the growth adjusted valuation is much more attractive than the PE, which suggests. So it is a high quality business, and it's becoming more embedded into its customer operations. And I really believe that it's the market underestimates Fastenal's ability to achieve scalable earnings growth.
You should tell him, Moment, haven't you taken your wife out to sticky, chewy chocolate cake? It's a sticky company, right? So that's one thing you can say. Let's look at Moments also said gross margins dropped already as they're chasing on-site accounts. So when does this low margin volume hurt the stock and prove you wrong, Hassan?
Okay, so this for me, okay. So yes, that is true. It did drop to 44.6%. While gross margins dropped, there seems to be a risk, which I highlighted in my report, is if Fastenal is unable to convert embedded accounts, deeply embedded customer account into larger wallet share, and if it's unable to continue to grow these on sites, then yes, it will hurt the stock. My assumption and my justifiable assumption is that Fastenal has the ability to convert a customer embedment into larger wallet share, and has that ability to continue to grow its on sites while still maintaining its revenue and actually increasing it.
Dang Moment says they're actively eating competitors' lunch right now. If you wait for the perfect macro setup or environment, you're going to miss the rally. What do you respond to that, Dang?
Yes, they are currently gain more and more market share from its competitor, but still that's not enough to justify its high premium right now, as the more they gain it still hurt more and more of its gross margin, which is its premium.
One last one from Momin. He says, you're talking about a fall in gross margin, but their SG&A discipline's pretty good, and they've kept operating margin at 20%. So why bet against this team that's executing well?
I think that its team is currently executing it well, but it's hard to come more and more from that, as I think it's currently at its limit.
Okay, that wraps up the Q&A section. Now make sure you mute your mic when the other person is speaking, because we're getting a little feedback. Now, before we move on, hold on. Let's go back to where we're at. So we now are entering the closing statements where each participant gets 3 minutes to summarize their position. Let's do it. Hassan, take it away.
Let's do it. Okay, so ultimately, based on all the arguments, so all the things that have been discussed right now, my buy recommendation lasts on one complete thing. Fastenal is no longer just a distributor; it is becoming an embedded supply chain partner. This matters because embedded customers are more valuable and more recurring and harder to replace. Fastenal through embedded customers ensures loyalty, and it is also already sitting in terms of fundamentals at the top of its peer group. Its digital footprint has already been more than 60% of sales. 95% of revenue comes from multi-channel customers. We, in my forecast and in the past quarters, Fastenal does face gross margin pressures. Yes, but that does not attack my recommendation. Why? Because I assume gross margin declines by around 110 basis points. The earnings upside and the buy recommendation comes from its SG&A leverage, the automation, as well as digital procurement, which are the key drivers of the industry that Fastenal operates in, the industrial distribution sector. Furthermore, it is not cheap. The company itself is not cheap on the headline multiples. But main question is this premium justified by the superior return on equity as and asset efficiency? Fastenal also has the lowest PEG ratio amongst the benchmark peers. Secondly, as I mentioned, the main risk is execution. If it is unable to convert its FMI on-site and digital tools into larger wallet share and greater revenue, yes, it will hurt the stock. But I believe Fastenal is more than capable enough to continue to remain at the top and achieve sustainable competitive advantage, higher margins, and greater asset efficiency, while at the same time being able to maintain strong operating leverage. Thank you.
All right, Dang, take it away.
Uh, Finally, for tonight, all I want to say is Fastenal is not a bad company. I not initiate sell recommendation out of the fear that this company is bad. But what I want to say is this company is great, but everything that great is already priced in. Its fundamental is good, yes. Its mode is good, yes. The company can grow, yes, but it's already priced in, and the price in and its premium is a little bit too high. Without further evidence, it can't sustain this, and it can't sustain its current price level, and it did more and more rating will bring this company price down. And that's all for me for tonight. Thank you.
All right, well done with your debate. And for the audience, what a great opportunity to hear both sides of Fastenal. How do you guys feel? Go ahead. How are you feeling?
It
A
was
bit
very,
pressure,
very,
yeah.
You
it was
guys
very,
both
it
wait,
was,
wait, you wait for each other, and then you both speak at the same time. All right, Dang, why don't you go first?
yeah.
Okay. Exciting and nervous at the same time. A bit pressure, yes. Hassan doing a good job on this
Yeah.
company. Yeah.
Yep. Hassan?
Actually, the sell side, Tang was very, very good at giving his points, and I really enjoyed debating with him. It was really, really interesting to see both point of views, but both making sense as well.
That's what makes this one so hard, right? Is that there's strong arguments on both sides. And that's often the case in the stock market, anyways, where, you know, the problem is sometimes you see a bad company and then it's really cheap. You know, there's an argument there. Just think about the fact that you guys knew nothing about this company, and here you are able to stand up and defend your position. You know, and when I was an analyst, it was just, you know, one of the joys of being an analyst is taking your story out to the world, taking it, presenting it, meeting fund managers who are going to put money behind it or not, who are going to believe you or not. Some are going to be true experts. I once met a fund manager in New York. This was back in about 1995. I was a bank analyst at the time, and I was talking to him about Bangkok Bank. And he started talking to me about what he knew about Bangkok Bank. I thought, how does a guy in New York City know this much about Bangkok Bank? And I asked him, how do you get your information about Bangkok Bank? He says, You see this phone number right here? That's the chairman. I just call him. And I thought, oh, so, he had, hundreds of millions of dollars invested in it. And here I was, an analyst trying to pitch my idea. So you sometimes pitching against people that really know what they're talking about, which is why it's really important to be thorough. So I just want to congratulate you both for, putting in all the effort it takes. And really, we're halfway there. In about 5 or 6 more weeks, we're going to be hearing your final presentations and seeing your final progress. So keep up the work, and you're going to continue to improve.
Thank you.
Yep. So we're going to end right there. And I just want to thank everybody for attending. For those people that want to build a competitive advantage in company valuation, join us in the next Valuation Masterclass Bootcamp. It starts on September the 7th. We'll see you there.